You've been told to aim for 1 to 2 or 1 to 3 risk to reward ratios on every trade, but here's the problem with that advice. That advice probably causes you to lose some trades, and that's the sad truth. I'm going to show you why risk to reward alone is useless without context and how real traders think about it. I'm going to break this video down to 3 different parts. The first part, I'm going to talk about why most traders misuse risk to reward. The second part, I'm going to talk about how to think about risk to reward logically. And then the third part, I'm going to talk about what actually works in the risk to reward aspect of your trading journey. By the end of the video, if I say something that you could plan on implementing in your own trading strategy, your own trading plan, drop a like, comment, and subscribe. And if you're going to stick with what you already do, just leave it in the comment section. That way other people can look at your risk to reward approach and see if it may work for them. Without further ado, let's get into the content. Let's get into part 1 on why most traders misuse risk to reward. So for one, I see this a lot, very often. A lot of people chase that 1 to 3 risk to reward ratio, that 1 to 2 risk to, not necessarily 1 to 2, but this mainly applies to 1 to 3s. A lot of people chase 1 to 3s on setups that isn't a 1 to 3 opportunity, right? That 1 to 3 don't overall align with structure. Looking at this example here, say this was a break and retest trader that had an aggressive breakout below this level of previous support, and you're looking at it to hold at new resistance. Price pull back into the area, give you a 5-minute bearish engulfing for entry reason. You have your stop loss above the overall level of resistance, anticipating that this level could hold, right? Then having that same approach where you're chasing 1 to 3s with a 17 pip stop loss, you're looking at a 54 pip, 52 pip take profit, right? Now, as you can see, price puts you well up in profit in this trade. Right, you were 30 pips in profit, almost at a 1 to 2, right? A little shy of 1 to 2. But because you're chasing that 1 to 3 risk to reward ratio, you end up letting this winning trade turn into a loser. Reason being, you're chasing this risk to reward ratio, and this risk to reward ratio doesn't align with structure. Looking at structure, this was the aggressive push down that created this low. Price created a lower high. At this point, price is coming down to retest this previous level of support in this case. This is where you should be looking to take some partials off this kind of trade. This setup doesn't provide a 1 to 3 risk to reward kind of setup. It's really a 1 to 2 max, 1 to 1.28. It's still a positive risk to reward, but a lot of people are chasing that 1 to 3 just to say they had a 1 to 3 trade and letting these winning trades turn into losers. When in reality, you should be looking to take partials or look to get out this trade as price come down, tapping into this previous level of support. Now, this is an area that price has previously rejected. So anticipating, knowing that price could potentially reject this area again, this is where you want to be trying to scale out of your position or at least taking some off. But a lot of people are chasing that 1 to 3 aspect and holding longer trades, but in reality letting these winning trades turn into a loser as price end up reversing off of this overall level. Let's get into part 2 on how to think about risk to reward logically. Now, this is my personal approach. I'm going to break it down in detail. So hypothetically speaking, say price is ranging something like this. We have a breakout, a retest, and I'm looking to take a trend continuation. If I look to take this kind of setup and I take a buy position like this, stop loss below the low, and say this high is only like right here, let me know that this is the area that price could potentially reject off of, and my stop loss have to be like this, right? This is a negative risk to reward. So seeing that this is a negative risk to reward lowers the probability. Seeing that this is a negative risk to reward, this is not something that I will be open to trade because my risk outweighs my profit based off of structure of an area that price could potentially reject, meaning price could come up, make an equal high, and then continue down and make a new low. Or price could come up, fail to make a new high, or fail to make an equal high, and then come down and take out all of the lows. That is a possibility. For every winning trade, there is also a chance that that trade could have been a loser. So knowing that, this is a step that I wouldn't take, being as though the risk to reward isn't a positive risk to reward. Instead, I'll wait for a better setup or a higher probable setup. Also, say hypothetically speaking, price does the same thing here where it fails to make a new high, or let's say it fails to make equal highs and then reverses. I still seen a 4% stop loss. I still see 8% profit, so I still hit for a 1 to 2, still positive risk reward. And this is where I'm taking partial of my position out, things of that nature, managing risk, trailing stop to break even, because I'm deep in profit, more than what I've overall risking. Say price creates equal highs. This is me scaling out, still taking profits off, managing risk with trailing stop loss in profit, not necessarily breaking, trailing in profit, things of that nature. Or even if price continues higher, and doesn't create equal highs in reverse, it continues higher, I'm still open to holding that, but I'm not necessarily chasing that 1 to 3 risk reward. I'm managing risk as price forms, as structure is forming, while also being in profit with trading a setup that provided a positive risk to reward. What I personally like to do is I like to partial out at my 1-to-1. That way, hypothetically speaking, say I am in a long position, right? Risking $1,000. Say I'm risking $1,000 on a long position at 10 pips stop loss, right? Once price hit my 1-to-1 target, I like to partial out half my position. So say price is moving, I hit my first target. Okay, boom, I'm up 1K. Instead of closing the 1K, I'll close 500, meaning I'll secure 500 as close, and that profit will be added to my balance, my balance. Then I will still have 5K floating profit. And in the event that price reverses and hits stop loss, this allows me to end the trade overall at break even because I already secured 50% of my position with 50% running. So based off my initial 1K risk, if price hits this stop loss point, I'm not necessarily losing my whole 1K. I'm only losing 500, but the 500 that I'm technically losing is the 500 that I already secured, meaning a break even trade. With this approach, this allows me to avoid getting broke even on trades that has potential to run to bigger risk rewards. So say price just wants to, say for somebody that's trailing stops to break even too early, and price comes down to break even and then they run. And they just got broken even on a trade that was overall still right or supported their directional bias, things of that nature. So they only missed out on potential further profits. Say price decides to overall say they don't take partials off and price overall reverse. Then they just let a potential winning trade turn into a losing trade, right? Because technically they were up what they were in profit what their risk was, so they were up a positive risk to reward. The way I do it lets me be in longer trades and still managing risk at the same time. Because say I never chose stop loss to entry at TP1 or my first 1-to-1. I take partials here, meaning I secured some. Price comes down to my entry and continues. I'm still in this trade as it's riding up. And that ties into stop loss placement a little bit. I'll make a separate video about that, but ideally your stop loss should be in the area that invalidates structure. So price could easily just come back down to entry after hitting my first target, even putting me in drawdown and still be bullish and then run. But people that chose stop loss to break even too early are getting out of this trade when they're not letting a full setup play out to the full target, which will be like another structure level looking left, things of that nature. So with my approach, I take partials out at my first TP1 and then I hold stop loss. Reason being, if I hold stop loss and price ends up reversing and hitting stop loss, it overall being a break-even trade. If price never comes back to entry, then I'm still within the trade, letting the trade go to my overall full take profit level. And if price decides to come back to break even and then go, I'm not getting stopped out at break even. I'm still being able to stay within this trade. Quick little recap. Don't chase 1 to 3 risk rewards, 1 to 3 risk rewards, whatever your risk reward is. Don't chase it. If the setup's there, take it. And your take profit levels should be based off of structure points and not necessarily the fact that you want to hit a 1 to 2 or you want to hit a 1 to 3, because that unnecessarily puts emotion in your trading plan that doesn't need to be in there. You want to really be robotic. Don't just copy risk to reward ratios. Use structure, use probability, and track your data. This is how you actually trade with risk to reward. And backtest. Don't just copy ratios. Use structure, use probability, and track your data. That's how you actually win with risk to reward. If this helped you, hit subscribe and comment your favorite risk to reward setup, and let's compare. It's your boy Traderholic, and I'm out, chat. Peace.